Good evening, everyone. It's Joseph here, coming to you live from Hamilton, Canada. I hope all of you are doing well. Excuse me. Today is April 12, 2026. It's about 12:40 a.m. here, Eastern Time, and I'm just coming on here. Sorry for being late, but just had a very busy day. So yesterday, I typically go live on Fridays for financial literacy, but I decided to do it today because I just was just quite busy yesterday with other things. So yeah, for those of you who may not know me, my name is Joseph from Hamilton, Canada. I am a retired IT professional from the banking industry. I am a financial coach, self-taught on financial planning, retirement planning. At the same time, very active stock market and real estate investor. I'm also a very proud digital business owner. So a lot of people have asked me why I started doing this, sharing my knowledge and experience on financial literacy. And my answer is really simple. And um, it's really targeting the kids and the young people out there. It's because financial literacy is not taught in school, and by all means, for those people who may not know much about financial literacy, I'm also wanting to inspire or educate all of you because, as I mentioned, this is not really taught in school, and I've learned it, experienced it, and I researched it a lot for many years while I was in the banking industry, and I really feel though is that during that time when I was doing my research, I really feel that this is becoming more and more important because of the situation that we're in globally, whether it's in Canada, U.S., or anywhere, different parts of the world. We're feeling the pinch, and we're feeling the cost of living is just going up. And historically, the economy or the cost of living, have gone up, and it hasn't gone down at all whatsoever. So when I did that, a little bit of research around that, I felt as though is that more and more people may need to learn more about financial literacy, and financial literacy is a big topic. It covers a lot of aspects of financials, from budgeting, financial planning, investing, retirement planning, and estate planning and stuff like that. So it really, and debt management, of course, right? It really, it's a big spectrum. And yes, I did experience all of that while I was young, while I was in the corporate world. You know, my wife and I, invested in real estate and the stock market, and by all means, we've learned a lot. We made some mistakes, of course, but I'm here to try to inspire and educate my followers and my viewers. So anyway, my simple answer is really about, wanting to share my knowledge, my experience in this space, and hopefully people can resonate or learn something from it. Just a disclaimer: I am a financial coach. I know I'm not a financial advisor. I don't have a certificate or whatnot. What I can say though is that the difference between myself and a financial advisor is that they have the certificate and they have license to sell you products and services. I don't. I don't intend to sell you anything. I'm here simply for awareness, educational, and inspiration. Okay. So, excuse me, my topic today, financial literacy, believe it or not, episode 20. I'm on my 20th episode now. And I'm so happy that I'm still able to put some content for you. But at the same time, I'm very happy for my viewers and followers who continue to comment and ask me questions. Therefore, I come up with contents that I can share with all of you and answering your questions at the same time. So in any case, yeah, episode 20, my topic is about what are the five sources of income in retirement here in Canada. Okay. I came up with this topic because I will be hosting I'll be a guest speaker. Uh, I think it's April 17th in 5 days to talk about retirement planning with my fellow business partners. And I feel, I want to share this information because maybe some people have not done their retirement planning, but um, I'm a bit going it's a bit backwards, I should say, because typically we start off. Well, I would like to start off with obviously the budgeting, the financial planning, the investing, and then the retirement planning, and so on and so on, right? But just maybe for a teaser for them, they want to talk about retirement planning, so I will go with that and see where it goes from there. So anyway, I'd like to just share the 5 sources of income in retirement, or during retirement planning in Canada, and a lot of people may not know about this, but I just want to share it with you. So the first thing is old age security, OAS, and guaranteed income supplement. So the old age security applies to people who are residents of Canada, who have been in Canada for 10 years. That's the minimum, and they will qualify for old age security. However, that 10-year minimum will it'll be prorated because there is a maximum here in Canada. So if you've lived here for 40 years, since you're 18 years old, for 40 years, then you will qualify for old age security, which is a maximum pay of $743 per month here in Canada. Okay. Now, I mentioned about GIS, Guaranteed Income Supplement. That works in conjunction with old age security. You can only apply for GIS once you reach the age of 65 and once you're collecting old age security. If you're not collecting old age security at the age of 65, then you cannot apply or get GIS. Okay, it works in conjunction. These two sources of income are actually tax-free. Old age security and GIS, they're not taxed at all. They're not taxed at all, which is a great income source, right? So a lot of people look forward to this income source at the age of 65. And mind you, you can defer it. You can defer your old age security to age 70 if you want, and you would get a higher pay than $743 a month. Okay. Yeah, there's a percentage of increase. I can't remember what the percentage of increase, but it does increase if you defer it to age 70. The second one I want to talk about is called Canada Pension Plan, or in Quebec, it's Quebec Pension Plan. So CPP or QPP. So this typically is a pension plan that was given to you by the government because while you are working, you pay in to the pension plan. So now when you retire, you can start receiving this pension plan when you retire. Now you can collect CPP or QPP at the age as early as age of 60. You can also defer it to 65 or 70, and you would get a higher pay. Okay, so typically in CPP, the average payment is about $800 Canadian, but the maximum is about 1,200 something Canadian. Okay, it depends if you contributed in full in your CPP for those years that you had worked, and you worked for so many years, then you would get the full payment at the age of 65, which is $1,200. But if you want to collect it early, then it's going to be prorated, and I think it gets reduced. I would say maybe about 36%, maybe reduced at the age of 60. Okay, so but then again, the average that people are collecting CPP right now is about $800 Canadian per month. Okay. The other thing, the third source of income, I will say, is the workplace pension plan. So this is typically a company-sponsored pension plan where they provide employee benefit if they want to contribute to the company pension plan. Typically, the company matches it up to 6%. And again, that all depends on the company, but my company that I work for, they would match up to 6% of our salary. And then so they would, we would put in, $200, and they would, you know, contribute up to 6% to match it, right? So it's a great, I call it profit sharing actually, because it's in a form of investment stocks within the company. And then you can also have it under defined benefit and defined contributory. The difference between the two is defined benefit is actually managed by the company itself, whereby defined contributory is managed by yourself, by the employee. Okay, but workplace pension is a great source of building your investment portfolio because of the company matching your contribution, and it's such a great benefit. Okay, so for those of you who are actually working for an employer that has this benefit, take advantage of it right away, because it's one of the best investments that you could ever have. Now, a lot of companies now these days have cut down on defined benefit because they don't want to manage it, because it's costly for them to manage. So that's why they're perhaps could be offering defined contributory. But even this this benefit of defined contributory, not a lot of companies are offering it anymore because it is costly to the company itself. Just imagine, right? They're offering to match your contribution, however much you put in, they match it 6%, up to 6%. Okay. So yeah, so it's a great benefit. A lot of employees should be taking advantage of this if it's offered in your company. So the fourth income source, I would say, is the Registered Retirement Savings Plan, the RRSP, or Registered Retirement Income Fund. When you turn age 71, you have to convert your RRSP into RRIF, okay? But they're pretty much the same, okay? So Registered Retirement Savings Plan is something that you would open. It's a registered account with a financial institution, and you start contributing to it, and you get tax deferral and tax refund. Okay, so the the RRSP, you would contribute on a yearly basis. You would be allowed 18% of your salary every year. Your earned income, I should say, 18% of your earned income from the previous year. So it's 18%. So that's the maximum you can contribute to RRSP. So every time you contribute, you get a tax refund, which is great. Great way for you to lower your tax bracket. Here in Canada, we have a marginal tax bracket. So the higher salary you have, the more taxes you pay. So by investing in Registered Retirement Savings Plan, it lowers your taxes because you're on a lower tax rate, and you get a refund on a yearly basis when you contribute. Okay. So yeah, it's another great source of income that people use. And one of the things that I have studied as well is that research is RRSP is great when you use it to retire early. And the reason for that is because if you retire early, let's say at the age of 60, and you're not receiving any pension plan or old age security because you want to defer it till 65, RRSP is the best for that because you don't have income when you withdraw from it. you will be in a lower tax bracket. So a lot of people have this misconception about RRSPs where they say, "Oh, you know what, if I withdraw it, I have to pay taxes anyways." Well, that all depends on your plan, the way you plan it. If you plan to start withdrawing your RSP when you're collecting government benefits like old age security and CPP, well, that's not really a good plan, because the old age security and the CPP is going to put you on a higher tax bracket with your RRSP or RIF withdrawals, right? So the best way, if you're gonna invest in RSP, is try to plan in such a way that you retire early at the age of 60 and you deplete your RSP at the age of 60 until maybe hopefully until 65, and you deplete it all. And the reason why I would recommend that you deplete it all is because RSP is one of those registered accounts that are highly taxed when your second or when your last spouse dies. Okay, so if both of you, if you're married, if you have a spouse and one spouse passes away, well, then the RSP of that spouse rolls over to the surviving spouse. However, if that surviving spouse or the last spouse dies, that RRSP is going to be what do you call this? Is going to be taxed with the deemed disposition from CRA, Canada Revenue Agency, as if you had sold everything. So that means it's going to get taxed 53 or 54%, which is the highest tax bracket. So you don't want to be in that position. You want to deplete your RSP, especially when the second spouse or the last spouse dies. You want to make sure by that time your RSPs are depleted, because it's just going to get taxed by the government. Okay, and it's the highest tax rate, because all of your assets, when the last spouse dies, all of their assets are deemed disposition, meaning as if they've sold everything. Okay, that year that they pass away, or the year that the last spouse passes away. Okay, so it's very, very important for those of you who have mistakenly understood the way RSP works. I'm telling you, the best way to optimize or to take advantage of the RSP is if you retire early, and because this way you're in a lower tax bracket, which means you're paying a lot less tax. Okay. I'm sure there's going to be some questions on this, and please, just comment below, and I'll be happy to clarify it for you. The fifth source of income is really a tax-free savings account. To me, this is my favorite out of all of them, to be honest with you. Tax-free savings account, anything you put in here, and there's a cap. So right now it's 7,000 every year, right? But since we've opened, or since this started, the TFSA, I think residents of Canada has a maximum. Well, I think it's 203,000 now, 203,000 contribution rule. So imagine to maximize your TFSA, you would have 203,000 in there tax free, right? And it will continue to grow because I highly recommend that you would put it under investment, not on GIC and not on savings, under investment, so that it will continue to grow tax free as well. Okay, so tax-free savings account is after tax dollars. So whatever money you put in here, it's already been taxed, but the growth underneath this or inside this account will be tax free. So imagine you can have 203,000 maximum TFSA, and when it grows, it's all tax free. Okay. So yeah, this tax-free savings account, to me, I highly recommend that people invest in this, especially those who are in a lower tax bracket, because there's really no point of those people that are in a lower tax bracket to invest in RRSP. Again, remember the purpose of the RRSP is to put you on a lower tax bracket, to lower your income so that you'll be on a lower tax bracket. Well, if you're already in a lower tax bracket, it's really pointless to invest in RSP. I would say invest in a TFSA. Everything in there is tax free. Now, when you maximize your TFSA at 7,000 per year, then anything excess, sure, by all means, put it in your RSPs. Buy your RSPs, right? And that way you can have both accounts earning at the same time. Okay, so tax-free savings account is really, really important and advantageous for the youngsters, young people who are just starting their jobs. Very good, very, very good account to start with. I mean, obviously you have to be 18 years old to open up this account. Same thing with RSPs, right? Yeah, it's very advantageous to have this TFSA as soon as they turned 18 and start investing in it, even $50 a month, or every 2 weeks, $50, put it in there and let the compounding interest work its magic, right? So for those youngsters, who would like to start investing, my advice to you is invest as early as you can. Take advantage of the compounding interest and take advantage of the lengthy horizon that you have, because the longer you are invested, the more the compounding interest will work on your favor. Okay, so it's very, very important for all the kids out there 18 and up to start investing on TFSA. Okay, so really that's the fifth, but I added a sixth income source here, which I think it's worth mentioning. But to me, the five, are the most important. So the sixth, I would say, is the first time home savings account, FHSA. The government of Canada is allowing residents to put in up to 40,000 of your money tax free. So this FHSA is sort of a hybrid account. It's like the same as TFSA and RSP combined. Okay, so whenever you put in whatever money you put in here, you will get tax deferral. You get a refund. Okay, but again, there's a cap. It's only up to $40,000, and it's good for 15 years. So if you don't happen to buy a home, because this is really for first-time home buyers, if you don't happen to buy a home within that 15 years, you can roll it over to your tax-free savings account. So it's a great, great vehicle if you want to save for buying a home. It's really good to have this account. Now, the Guaranteed Investment Certificate, GIC, I only added this in there because to me, this investment is good for those people who want guaranteed return, but the returns are very, very minimal because it's based on bonds or interest rates, right? So you're looking at 2, 3, sometimes 1%, 3%, 4%, 5%, maybe not even 5%. You'd be lucky to get 5%. And the problem is that when you invest in GIC, all of the growth is 100% taxed. So that's why it's not my favorite. GIC to me is it's really for a short-term investment. So if you want to, purchase a car within a year or two, then you want to have a safe investment, put it in GIC. But to me, it's really not one of my favorite investments. I'd rather just put it in on ETF or on stocks. So let it grow that way. And what I'm saying is, not too risky, right? Not too risky. More of on the balance fund, and put it in there and just wait for a year and then buy your car whenever you want to, or whatever your goals are, right? So GIC, it's not one of my favorite, but it really just low income with 100% tax and growth. And then dividends. Dividends is something that I really like. It takes time to build a good paying dividends, but dividends are pretty much buying stocks from the company, and they pay you dividends on a monthly, quarterly, semi-annually, or yearly basis. And it doesn't matter whether the stocks goes down, you still get paid the dividends because you bought shares from the company. To me, it's a great source. Dividends is a great source of retirement income, but it takes time to build it up, to build up your capital. Imagine, for you to get a very good payout on dividends, you gotta have hundreds of thousands of dollars, or to get a good amount of payout, right? But a lot of people are doing it because it's it's stable, especially if you're investing on aristocrat companies, right? That pays out dividends on a consistent basis. Okay, so yeah, so that's really all I wanted to share with you tonight. This is something that I will share with my business partners as well, on my next meeting with them on April 17th. But I just wanted to, share this with you as well, because who knows, some of you might be watching this live or in a replay, and you might, think about it, and you might be inspired, or at least hopefully have learned something from this content. So anyway, that's all I wanted to share. Until my next episode, I'd like to wish you guys have a great day, great evening, great morning. Until my next episode, bye for now. God bless you all.